Let me begin with a simple but brutal math question, especially relevant for a stock like BigBear.ai. Suppose a stock falls by 90%. How much does it need to rise just to return to its original price? It needs to gain 900% from the lower level. Now let us make the decline only slightly worse. Suppose if the stock actually fell by 95%. How much does it need to recover then? A staggering 1,900%. That is 1,000% more than the previous case. Think about that. Just 5 additional percentage points of decline roughly more than doubles the recovery required. If someone can invest at that low and the stock returns to its original price, the return would be life-changing. $10,000 invested in a stock that fell 95% will be $200,000 if the stock returned to its original price. And Big Bear provided a couple of such opportunities. It has repeatedly delivered enormous rallies, however, followed by devastating declines. So is this a hidden artificial intelligence opportunity or simply a stock that keeps creating new big bears? In this video, we will begin with a brief overview of what the company does. We will then examine its technical history, dive deeper into its financial statements, review the price targets issued by different analysts, explore the company's products and government relationships, and finally reach a balanced conclusion. Let us begin. BigBear.ai is an artificial intelligence company that helps governments and large organizations make faster and better informed decisions. The company was founded in 1988 and is headquartered in McLean, Virginia. Its technology is mainly used in 3 areas: national security, supply chains, and digital identity. In supply chain management, it helps organizations monitor inventory, anticipate delays, optimize delivery routes, and test different operating scenarios before committing significant resources. In defense and intelligence, the company provides artificial intelligence tools for forecasting, cybersecurity, autonomous systems, operational readiness, and mission planning. It also provides biometric and digital identity technology used at airports, border crossings, seaports, and other secure locations. The company has also developed Ask Sage, a secure generative artificial intelligence platform designed for government agencies, defense organizations, and regulated industries. In simple terms, BigBear.ai's most important competitive advantage is its experience working with government customers, together with the security clearances and certifications required to operate in highly sensitive environments. These clearances can take years to obtain. That creates a barrier for new competitors that may have strong technology but lack permission to deploy it inside sensitive government systems. Now, let us move to the chart. BBAI has not behaved like a normal, steadily trending stock. Its trading history has been dominated by extremely rapid rallies, deep corrections, price gaps, unusually heavy volume, and repeated movements of more than 20% in a day. The stock's 5-year beta is approximately 3.08, suggesting that its historical volatility has been substantially higher than that of the broader market. Approximately 27% of its public float was also recently sold short. High short interest can create 2 opposite outcomes. On one side, it shows that many traders are betting against the company. But on the other side, high short interest can also fuel a sudden short squeeze if the company announces unexpected positive news. Short sellers may rush to close their positions, adding even more buying pressure to an already rising stock. After listing at approximately $10 in 2021, BBAI reached around $12.7 in April 2022. But that rally completely failed. The share price eventually collapsed to approximately 57 cents, representing a decline of more than 95% from its previous high. Remember this number? During 2023, Big Bear announced its participation in a 10-year, multiple-award U.S. Air Force IDIQ contract with a stated ceiling of $900 million. The stock reacted explosively. It climbed from its low of 57 cents to around $6.11, representing a return of well above 900% from the bottom. But did the rally last? No. Later that year, the stock fell to approximately $1.55, a decline of around 74%. This established one of the most important characteristics of BBAI's chart. The stock can rise 500%, 900% on good news, and then behave as if it never read the news. Major announcements can produce explosive rallies, but those gains have often proved difficult to sustain. The same pattern continued during 2024. The stock traded as low as approximately $1.19 and as high as $4.81. That represented an increase of around 304% from its lowest point of the year. Then came 2025, the real roller coaster ride. BBAI began the year strongly and reached approximately $10.36 in February, crossing its original listing price for the first time after that 95% decline. That was more than a 100% return from the beginning of 2025 level and approximately a 1,500% gain from its historic low of 57 cents. But only a few months later, in April, the crash came and stock had fallen to around $2.36. That represents a decline of 77%. Imagine buying near $10 because of excitement around artificial intelligence and only to watch more than 3/4 of your investment disappear within a few months. The optimism returned again later in the year. BBAI climbed to around $9.39 in October, gaining approximately 300% from its April low. But once again, the stock failed to hold those levels, ended the year at approximately $5.40, a decline of around 43% from its 2025 high. To understand just how volatile this stock is, consider this. BBAI moved by more than 20% in a single day 10 times during 2025. In 2026, the stock again began strongly and reached approximately $6.6. But by March, it had fallen to around $3, a decline of approximately 55%. At the moment, it is trading at approximately $3.8, which is around 70% below its historic high. So what does the charts tell us? Technically, BBAI is trading in the lower portion of the range it has occupied since listing. However, approximately 62% of the trading days since its listing have occurred at or below the current price. That suggests the stock has historically spent much more time around lower levels, while occasionally jumping to higher levels following major announcements, artificial intelligence enthusiasm, or short squeezes. In other words, the stock does not appear to rise gradually and remain there. It often stays quiet at lower levels, explodes upward when positive news arrives, and then gives back a significant part of those gains. The company has, unfortunately, followed its name rather well. Since listing, it has repeatedly created some very big bears for investors. Every time the stock rallies, investors see a hidden gem. Every time it falls, they discover the gem was hidden for a reason. Another factor to watch is Palantir. Companies such as BigBear can trade partly in sympathy with Palantir because investors often group them together as government-focused artificial intelligence and defense technology businesses. When Palantir declines, other companies in the sector may also come under pressure. When Palantir begins moving upward again, traders may start searching for smaller companies that could potentially benefit from renewed enthusiasm. However, BigBear should not automatically be treated as a cheaper version of Palantir. Despite the decline in BBAI's share price, its price-to-sales ratio remains above 13. That is still an expensive valuation. Companies trading at similar price-to-sales multiples are generally in a much stronger financial position than BigBear. Before we continue, a quick request. These videos take a lot of time and research to create. Subscribing to the channel is a simple way to support this work, and it would mean a lot. Now, let's move forward. And this brings us to the most important part of the analysis, the financial statements. This is important because when BigBear rallies, everyone calls it the next Palantir. When it falls, everyone suddenly remembers the financial statements. When we examine BigBear.ai's balance sheet for the year ended December 2025, the first thing that stands out is the dramatic increase in total assets. Assets increased from approximately $344 million in 2024 to around $895 million in 2025. At first glance, that appears very positive. The company also reduced its debt, and its balance sheet now looks significantly safer. But we need to ask an important question. Where did this improvement come from? The reduction in debt was not mainly achieved through strong profits or operating cash flows. A substantial amount of convertible debt, around $100 million, was converted into shares. That means creditors became shareholders. The debt burden declined, but existing investors were diluted because the number of shares outstanding increased significantly. The company does not currently appear to face an immediate liquidity crisis. Its current ratio is approximately 1.8 times, meaning current assets exceed current liabilities. However, when we move from the balance sheet to the profit and loss statement, the picture becomes much more concerning. Revenue declined by approximately 19%. Gross profit declined by approximately 37%. Gross margin fell from around 28% last year to 22% this year. This decline in gross margin is particularly important. Many established software-as-a-service companies generate gross margins above 50%. BigBear's gross margin is substantially lower, partly because the company still performs significant contract-based and service-based work. The decline in revenue was attributed to lower activity on U.S. Army programs and certain one-time contracts completed during 2024 that did not repeat in 2025. But the bigger problem is that gross profit fell much faster than revenue. This suggests that some of the contracts that ended carried stronger margins, while the remaining revenue mix was less profitable. At the same time, selling, general, and administrative expenses moved in the opposite direction. They increased by approximately 19% to $95 million. Selling, general, and administrative expenses represented approximately 75% of revenue in 2025, compared with around 51% in 2024. That is an alarming level of overhead for a business already experiencing declining revenue. Operating loss deteriorated from approximately $133 million in 2024 to around $214 million in 2025. The company also recorded approximately $70 million of goodwill impairment and $53 million of intangible asset impairment. Together, those impairments amounted to approximately $123 million. Impairments are non-cash accounting charges, but they still tell us something important. They suggest that previous acquisitions or acquired assets did not produce the financial performance management originally expected. And now Big Bear is once again positioning itself to make additional acquisitions. That raises an uncomfortable question. Has management learned from the previous deals, or could shareholders once again finance acquisitions that eventually require large impairment charges? Cash flow also remains weak. Operating cash outflow was approximately $18 million in 2023. It increased to approximately $38 million in 2024. It then increased again to around $42 million in 2025. So, despite the large increase in cash and investments, the underlying business is still consuming cash. The company's excess liquidity did not come from profitable operations. It came mainly from issuing new shares. A significant portion of that capital is currently parked in available-for-sale investments, including U.S. Treasury securities and other debt securities, totaling approximately $375 million at the end of 2025. Backlog is another important area to examine. Big Bear's total backlog fell from approximately $418 million to around $248 million. That represents a decline of 41%. Backlog was 1.9 times the company's 2025 revenue, compared with around 2.6 times the previous year's revenue. A declining backlog may indicate weaker future revenue visibility, although not every type of backlog has the same certainty. Government contracts frequently contain options, funding conditions, and termination for convenience clauses. Therefore, even reported backlog should not automatically be treated as guaranteed future revenue. The AskSage acquisition. Big Bear acquired AskSage for approximately $272 million. The acquisition closed on the final day of 2025, so almost none of AskSage's revenue or expenses were included in company's reported full-year 2025 results. AskSage's estimated full-year revenue was approximately $15 million. Based on that figure, Big Bear paid approximately 17.8 times revenue. That appears expensive. The purchase price allocation included approximately $84 million of identifiable intangible assets and around $192 million of goodwill. Goodwill represented 71% of the purchase price. This means most of the acquisition's value does not come from physical assets or easily identifiable financial resources. It depends on expected future growth, synergies, customer expansion, and the long-term value of AskSage's technology and government certifications. But investors should remember that approximately $85 million of goodwill impairment during 2024 and approximately $123 million of goodwill and intangible asset impairments during 2025. That is more than $200 million wiped out from shareholders in 2 years. If AskSage can continue expanding revenue while maintaining higher gross margins, the acquisition price may eventually appear more reasonable. Shares outstanding increased from approximately 252 million in 2024 to around 476 million more recently. That represents an increase of approximately 90%. In other words, the number of shares has almost doubled. Big Bear substantially reduced its balance sheet risk, acquired AskSage, and accumulated significant liquidity, but existing shareholders paid for much of that improvement through dilution. Imagine owning one slice of a pizza divided into 8 pieces. If the same pizza is suddenly divided into 16 pieces, your one slice represents a much smaller percentage of the whole and would seem unfulfilling. The company has also increased its authorized shares from 500 million to 1 billion. This does not mean all 1 billion shares have already been issued. but it does give management the legal capacity to issue a very large number of additional shares in the future. Good luck with you, pizza. In the last, let us quickly glance at the first quarter of 2026. There was one encouraging development. Gross margin improved significantly. Gross margin increased from approximately 21% in the first quarter of 25 to around 34% in the first quarter of 2026. Revenue, however, remained broadly unchanged compared with the previous year. The improvement in gross margin was mainly driven by Ask Sage's higher margin revenue. Ask Sage contributed approximately $6 million during the quarter, representing around 18% of BigBear's total revenue. That is important. Ask Sage generated an estimated $15 million of revenue during the whole of 2025, but produced approximately $6 million in just the first quarter of 2026. If that momentum continues, Ask Sage's full-year revenue could begin to challenge the assumption that BigBear paid an excessively high acquisition multiple, but we should remain cautious. One strong quarter does not prove the acquisition will succeed. At the consolidated company level, net losses remain substantial. Operating cash flow also worsened during the first quarter. So while Ask Sage improved the revenue mix and gross margin, the overall company has not yet demonstrated sustainable profitability. Backlog increased by approximately 13% during the quarter and reached around $282 million. That is a positive sequential improvement. However, BigBear continues to generate significant losses, so part of its additional capital will likely be used to fund operations, employee expenses, research, sales efforts, and acquisition integration. Before moving forward, just a friendly reminder. This video is not a financial advice. Now let us examine what different analysts and financial websites are predicting for BigBear. First, stockanalysis.com currently categorizes the stock as a buy. However, this does not appear to be an extremely confident buy. The analysts followed by the website have an average 12-month price target of approximately $5.33, with a high target of around $6. Next, MarketBeat categorizes BigBear as a hold, although the overall inclination appears closer to cautious or negative. Its reported analyst targets suggest a possible price range of approximately $5.5 to $6 over the next 12 months. PriceTargets.com also appears relatively cautious. Its consensus recommendation is hold, with a price target generally around $5.5 to $6. Finally, TipRanks also reports a hold recommendation, with a 12-month target of approximately $5. One interesting observation is that the lowest numerical target among these sources is still around $5. From a current price of approximately 3.8, that would represent a potential return of around 35%. A move towards $6 would represent a return of more than 50%. That may sound attractive, but remember, analyst price targets are not guarantees. BigBear is covered by only a small number of analysts, and price targets can change quickly following earnings results, contract announcements, capital raises, or changes in market sentiment. With a stock this volatile, the journey toward a target can also involve severe declines along the way. Company strengths and current activities. So far, we have identified more negatives than positives, but BigBear does have some genuine strengths. Its Chief Executive Officer, Kevin McAleenan, previously served as Acting Secretary of the U.S. Department of Homeland Security and Commissioner of U.S. Customs and Border Protection. That experience may help BigBear understand government procurement, national security requirements, and the operational needs of federal agencies. BigBear historically operated largely as a government services contractor, providing cleared analysts and specialists. That model can generate revenue, but it is difficult to scale because growth requires more employees. The company is now trying to shift towards software-based products that could generate higher margins and more recurring revenue. Some supporters compare BigBear with an early-stage Palantir. That comparison may be exaggerated, but it highlights the opportunity. BigBear may be able to combine government relationships, security clearances, and artificial intelligence software in a way that few smaller companies can replicate. Digital identity and commercial applications. A significant part of BigBear's airport presence comes from Pangiam and its Veriscan biometric platform, acquired in 2024. According to the company, Veriscan has been deployed at more than 15 international airports, used by over 60 major airlines, and processed more than 35 million passengers. Its airport presence reportedly includes Chicago O'Hare, Dallas-Fort Worth, Denver, John F. Kennedy, Los Angeles, Charlotte Douglas, Seattle Tacoma, Ronald Reagan Washington, and Nashville International Airport. The system uses facial biometrics to verify passenger identities, potentially reducing the need to repeatedly present passports and boarding documents. BigBear has also expanded this technology into cruise terminals and seaports. In May 2026, Panama Transshipment Group became the first commercial user of a BigBear-powered cargo security system combining artificial intelligence, cargo tracking, biometric verification, and chain of custody information. This is strategically important because it shows BigBear expanding beyond government contracts into international logistics. However, investors still need to ask how much revenue these deployments will generate and whether they can be replicated at other airports, ports, and logistics companies. Healthcare and digital twins. BigBear is also active in healthcare and industrial planning. Thomas Jefferson University Hospital has used its FutureFlow RX platform for bed management, nurse staffing, patient transfers, and facility planning. The company has also worked with C-SPAN through its Shipyard AI system to test production schedules, facility improvements, and resource requirements. These examples show that BigBear's technology can be applied beyond defense, including healthcare, manufacturing, and logistics. The challenge is turning these projects into substantial recurring and profitable revenue. Government and defense organizations remain BigBear's most important customers. The company has a 5-year U.S. Army contract worth approximately $165 million for the Global Force Information Management Platform. It also participates in a 10-year U.S. Air Force Multiple Award IDIQ contract with a ceiling of $900 million. But this requires an important clarification. The $900 million is the total contract ceiling, not guaranteed revenue for BigBear. Multiple companies compete for individual task orders. BigBear also holds positions on U.S. Navy and Federal Aviation Administration contract vehicles and works with U.S. Customs and Border Protection. These relationships demonstrate the value of the company's government access and security credentials. But investors must distinguish between being eligible to compete, actually winning a task order, and ultimately recognizing profitable revenue. Headlines may focus on the largest contract ceiling. The financial statements show how much money the company truly earns. So, after examining BigBear's chart, financial statements, acquisitions, analyst targets, and commercial activities, what conclusion can we reach? The company's technology helps its customers make better decisions, although its investors are still waiting to see whether buying the stock is one of them. BigBear.ai is a highly speculative artificial intelligence and defense technology company with some genuine strategic advantages, but the risks remain substantial. Revenue declined sharply during 2025. Operating losses increased. Cash burn remains significant. Previous acquisitions resulted in major impairment charges. Insider ownership is low, and the number of shares outstanding has almost doubled, with the possibility of further dilution after authorized shares were increased to 1 billion. Technically, BBAI has repeatedly produced extraordinary rallies, but it has also repeatedly destroyed those gains. This company may create opportunities for disciplined traders, especially around major announcements and periods of high short interest. But for long-term investors, the company still needs to prove that it can convert artificial intelligence enthusiasm, government access, and shareholder-funded acquisitions into sustained revenue growth, positive operating cash flow, and eventual profitability. If you found this video valuable, please give it a like and subscribe for more analysis of other companies.